When Warren Buffett pays a lower tax rate than his secretary, he's not breaking any laws. He's using a strategy that most people never learn about: legal entity structures. While you're paying taxes on every dollar you earn, billionaires are moving their wealth through carefully designed legal entities that slash their tax burden and protect their assets from lawsuits. The ultra-wealthy understand something that most people don't: your name should never appear on valuable assets. Every billionaire family uses multiple legal entities to hold their wealth, and today you're going to learn exactly how they do it. This isn't about hiding money or doing anything illegal. These are completely legal strategies that have been used by wealthy families for generations. The only difference is that now, these same tools are available to everyday people. Most people make a critical mistake that keeps them poor and vulnerable. They own everything in their personal name: your house, your car, your investments. If they're all in your name, you're setting yourself up for financial disaster. Here's what happens when you own assets personally. First, you pay the highest possible tax rates. Personal income tax rates can reach over 37% at the federal level, plus state taxes. The wealthy avoid these rates entirely by using entities. Second, personal ownership makes you a lawsuit target. If someone slips on your property or you're in a car accident, they can come after everything you own. Lawyers specifically look for people with assets in their personal names because they're easy targets. Third, personal ownership limits your tax deductions. When you own assets through the right entities, suddenly expenses become deductible that you could never deduct as an individual. The wealthy learned long ago that personal ownership is for poor people. They use legal entities as shields between themselves and their wealth. The limited liability company is the foundation of most wealth protection strategies. Think of an LLC as a legal wall between you and your assets. When you own real estate through an LLC, you're not personally liable if someone gets hurt on the property. But here's where it gets interesting for taxes. An LLC can choose how it wants to be taxed. By default, it's a pass-through entity, meaning profits flow to your personal return. But you can elect to have it taxed as an S corporation, which can save you thousands in self-employment taxes. Let's say you make $100,000 in business income. As a sole proprietor, you'd pay self-employment tax on the entire amount. That's over $15,000 in additional taxes. With an S-corp election, you only pay self-employment tax on your reasonable salary, not the entire profit. The ultra-wealthy take this further. They create multiple LLCs for different purposes. One LLC might hold real estate, another might hold investments, and a third might operate a business. This compartmentalization protects each asset class from the liabilities of the others. While LLCs protect you from liability, trusts protect your wealth from taxes and provide generational wealth transfer. The wealthy use trusts to remove assets from their taxable estate while maintaining control. An irrevocable life insurance trust is a perfect example. When you own a life insurance policy personally, the death benefit is included in your taxable estate. But when the trust owns the policy, the death benefit passes to your heirs tax-free. Charitable remainder trusts let you donate appreciated assets, get an immediate tax deduction, receive income for life, and pass remaining assets to charity. It sounds complex, but it's a way to turn a tax problem into a tax solution. The key insight is that trusts allow you to separate ownership from control. You can give away assets for tax purposes while still maintaining practical control over them. Family limited partnerships are how billionaire families transfer wealth across generations while minimizing taxes. The parents contribute assets to the partnership and retain control as general partners. Then they gift limited partnership interests to their children. Here's the magic: those partnership interests can be valued at a discount because they lack control and marketability. A 30 to 40% discount is common. This means you can transfer $1 million in assets by only using $600,000 of your gift tax exemption. The Walton family has used this strategy to transfer billions to the next generation while paying minimal estate taxes. They contribute Walmart stock to family partnerships, then gift discounted partnership interests to their children. This isn't just for billionaires. Any family with significant assets can use this strategy to transfer wealth efficiently. The ultra-wealthy often add international components to their entity structures. This isn't about hiding money, it's about jurisdictional diversification and enhanced asset protection. A Cook Islands trust, for example, provides stronger asset protection than domestic trusts. The Cook Islands don't recognize foreign judgments, making it nearly impossible for creditors to reach trust assets. International LLCs can provide tax deferral opportunities for certain types of income. A Nevis LLC offers some of the strongest charging order protection in the world. The key is compliance. These structures must be properly reported to the IRS, but when done correctly, they provide legal benefits that domestic structures cannot match. You don't need millions to start using these strategies. Here's how to begin implementing entity structures on any budget. Step 1. Form an LLC for any business activity or real estate investment. This immediately provides liability protection and potential tax benefits. Most states allow you to form an LLC for under $500. Step 2. Consider an S-Corp election if you have significant business income. This can save thousands in self-employment taxes annually. Step 3. Explore trust structures if you have life insurance or want to begin estate planning. A simple revocable trust can avoid probate and provide privacy. Step 4. As your wealth grows, add more sophisticated structures. Step 5. Always work with qualified professionals. Entity structures must be properly formed and maintained to provide their intended benefits. The most important step is to start. Even a simple LLC provides more protection and tax benefits than personal ownership. The ultra-wealthy use legal entities because they understand that how you own assets is just as important as what assets you own. These aren't exotic strategies reserved for billionaires. They're tools that anyone can use to protect and grow their wealth. The difference between the wealthy and everyone else isn't just how much money they have, it's how they structure that money. While most people focus on earning more, the wealthy focus on keeping more through smart entity structuring. Don't wait until you're wealthy to start thinking like the wealthy. The best time to implement these strategies is before you need them. Every day you delay is another day your assets remain exposed and your taxes remain unnecessarily high. If this video opened your eyes to how the ultra-wealthy really protect their money, subscribe to Stealth Wealth Hacks for more strategies that the 1% use but rarely share. Your financial future depends on learning these insider techniques.